Governor Bailey, thank you so much for speaking to Bloomberg. Now, you've pushed back very hard against market pricing today. Why not do it before?
I don't think it's our job to steer markets day by day and week by week. Take the statement I made a couple of weeks ago, as a number of people raised. We make a lot of conditional statements, rightly so, because obviously, a lot of our statements are, well, if the following thing happens, then it will lead to the following. And it was a very clear statement by me that if we saw evidence, particularly that medium-term inflation expectations were becoming de-anchored, then we would have to act, and we would act. Now, that's a conditional statement, but of course markets have to translate that into unconditional actions. I will understand that. By the way, I would also add that I think over the course of the summer, we were observing evidence, obviously, of rising inflation pressures. We had some language in various of our publications suggesting that there would have to be, I think we used the word modest rise in interest rates. Interestingly, we were observing market rates coming down. You look at 10-year government bond yields, both, not just here actually, it was in the US as well, for instance, coming down as this inflation pressure was growing. So we were a bit puzzled by that, frankly, and perplexed. And there came a point where I think we have to increase the sort of, in a sense, increase the volume of the message, and that was deliberate on my part, because I was concerned that we could see, obviously, the rising inflation pressures. Now, I think you're right that today, two messages. One, we expect there will need to be a rise in interest rates. Two, however, because we condition our forecast on the market curve, as I did point out, our forecast suggests that by the end of the forecast period, 3 years away, inflation was coming a bit under target, probably on a declining trend, and we had an output gap opening up, and obviously that wouldn't be what we were wanting to see.
Governor, if we can go back to markets, and it was this "we will have to act" that at the time seemed pretty hawkish.
Yes.
So again, why did you not temper it, or did you actually at the time, weren't not enough worried about growth?
No, it's a statement. And by the way, it's a statement I hold to today, which is that, of course, in those conditions, particularly if we're seeing, inflation expectations beginning to become de-anchored, we will have to act. There's no question about that. I don't resolve from that one bit.
But so did the markets misread you? Is there a communication problem?
No, I don't think they misread at all. What I would say, however, is that nobody in the Bank of England, me included, said, therefore, there will be a rise in interest rates in November. That was nothing. We've never said that. Now, actually, interestingly, and I think Bloomberg, you published your economist survey, and it was pretty evenly balanced on what we were going to do today.
But the markets didn't. So do you think you've lost credibility with the markets?
But that's the interesting thing, isn't it? That we pick up quite a lot of commentary which matched your survey. So a lot of people said to me, a lot of people were saying to us, it's pretty close. And my view would be, yeah, it was pretty close. It is a very, very finely balanced situation. Now, market pricing, I think, as you could tell from the commentary we made, today, right direction, some bit overdone, in my view, if you want a candid view.
Governor, there's quite a lot of traders, when you look at some of the analyst notes, that say, look, if MPC members had not spoken so much over the past month, market pricing would have been aligned with the statement. So would MPC remarks be more valuable if they were less frequent?
Well, I do take that with a fair pinch of salt, because we get comment at other times that, if the MPC doesn't speak, then, markets get no guide. So now, of course, we don't speak to guide markets, put it that way. I mean, the markets must, draw what conclusions they will from what we say. So I honestly take that with a fair pinch of salt. What I would say is that I think we have seen a correction in markets from the pricing we saw over the summer, particularly. And I have to be honest with you, I'm not surprised about that. It puzzled me at the time to see that pricing.
When you look at, what does coming months imply? Does it mean no hike in December?
No, it doesn't. I mean, what it means is that coming months is from now onwards. And it means, no more, no less. It doesn't mean, we're giving a signal on any one meeting. Nothing's off the table, nothing's on the table in that sense.
I mean, there is a bit of tantrum in the markets, which is not a taper tantrum. So I don't know how you would describe it. And again, whether it changes the way that you will, communicate with the markets going forward.
No, I think there are times when, we have over the summer, I think, we're giving, messaging. If you take the August monetary policy report, you take some of our minutes, we were giving messages which I think were clear in our mind, but I don't think they were going in somewhat a different direction from the way markets were going. And I think there was given what has happened in the economy, given what's happened to inflation, in the context of that, I think it was necessary to give a stronger message.
You're emphasizing growth now more than inflation. Why?
Well, I wouldn't put it quite like that. I think the issue with inflation is this. Much of the cause of the higher inflation is to do with supply bottlenecks around the world. And the causes of those supply bottlenecks will not be addressed by raising interest rates. So, I've said quite a few times, I'm afraid raising interest rates will not cause us to have more gas. It won't cause semiconductor chips to appear suddenly. We have to be conscious of that. This is one of the difficulties. Monetary policy is designed for sort of movements in demand relative to supply, if you like. Here we're dealing with the causes, which are much more to do with the supply in the economy. So we have to be careful, therefore, with the inflation story. We have to, in a sense, look at this whole question about how temporary or transient this rise in inflation is going to be. We would always do that, but particularly at the moment, because our tools are not well suited to tackling the underlying causes, and we're far more interested in preventing what I might call the sort of the second round effects or knock-on effects from that. So, to go to your question in terms of growth versus inflation, it's not a sort of we're now on growth, not inflation. It's just that we're sort of realistic about what we can do about the immediate causes of higher inflation.